Welcome back. Canadian tech giant Shopify posted fourth quarter results at about 7 a.m. Eastern time this morning, about 2.5 hours ago. The company exceeded expectations on several key metrics, but its projected free cash flow appears to have disappointed investors. The stock was down in pre-market trading, then it reversed and it was up in the late pre-market and now in regular market trading. As you can see, it's up by about 2.25%. To sort it all out, we're joined now by Gil Luria at Davidson. He's bullish on the stock with a price target of $130 per share. Gil, thanks a lot for joining us. So how do we make sense of these numbers and the market reaction? The company did report stronger revenue than expected, but the free cash flow guidance in the very early going after the numbers were released at 7 a.m. seemed to be a concern to investors.
Yeah, the revenue growth is phenomenal. This is one of the very few companies that's still growing more than 30% and just guided for growth at least in the mid to high 20s. And so there's a little bit more of an understanding and patience for free cash flow guidance being slightly less than expectations. Having said that, cash flow margins will be up year over year, and overall margins this year should be at the least flat. That's what the company said. They are, because the growth is so high, they're reinvesting in the business. And at around the margins there are around 20%. They're comfortable with those margins, and they're going to focus on driving even more top line growth.
What's it telling us that the market has not been able to make up its mind here?
I think that the stock should be up and will continue to be up and from here on in, because the company that's growing this fast is so rare right now that investors will give it a pass on margins. And these are good margins, and investors will give you a pass if you can keep growing in the mid to high 20s. That is very rare air. We're really just down to Shopify and Palantir at this point. There's very few, if any, software companies, especially at this scale, that are growing this fast. And that's really is the only way you get a pass on margins.
Okay, we should bring up the U.S. listed Shopify shares. That's SHOP in New York, I believe, on the NASDAQ. Here it comes on the New York Stock Exchange. There's the price at roughly $121 US per share. Your target, Gil, is 130. What kind of valuation metrics and forecasts do you use to get to that target?
Yeah, so because it's such high growth, we're comfortable putting a revenue multiple, and in fact, a double-digit revenue multiple on Shopify. And again, keep in mind, it's a race of two super ultra fast-growing software companies. Palantir is trading at 70 times revenue, and Shopify is still trading in the teens. So for pretty similar growth rates, and in our mind, pretty similar ramps ahead of them. So Shopify is trading in line with other high growth software peers, and we think they can sustain that. And again, their ramp is long because this shift to e-commerce that's been happening for decades will happen for decades longer. Shopify is a share gainer, and they've found additional growth engines. They're going up market, they're growing B2B, they're growing offline, they're using AI to get a premium product out there. So Shopify has plenty of growth engines and this long-term secular trend.
You say one of their growth channels is offline. Explain.
There are shops that you go into and you pay on a Shopify terminal, which therefore is processed through Shopify payments. And that's a big growth business for them. It's a business they compete with the likes of Square and Toast, et cetera. And they're having a lot of success because there's a lot of merchants that sell online that want to extend their retail operations into a physical store, and Shopify allows them to have that extension.
And you mentioned that the company is a share gainer. Who is it winning share from?
All of the rest of retail. As we move to e-commerce, that's still double-digit growth compared to maybe low single-digit growth for offline commerce overall globally. And Shopify is it's become the default for starting a shop online. So as entrepreneurs all over the world want to start selling online, it's almost the natural choice for them to start on Shopify, and that takes share from everybody else.
As you've been speaking, I've been trying to determine whether the conference call is underway or not. In fact, it began at 8:30 a.m. Eastern time, so it may still be underway. And my question is a bit offbeat. It certainly doesn't concern the company's financial performance. Do you believe the company owes an explanation for why a T-shirt with a Nazi swastika was being sold on a Shopify website after apparently the company loosened its content rules?
I think that's something they need to look into. There was a question on the call, and they didn't answer it on the public call. And the call is now over. I would think that they're preparing a response, possibly challenging their policies in order to make sure that doesn't happen. It is very upsetting.
Gil, thank you as always for your views on a very, very closely watched stock in this country and really around the world, Shopify, which has reported results